tonight is Guy Berg. He's a member of the Federal Reserve Payments Improvement Leadership Team and leads industry engagement to catalyze B2B payment improvements, leads the Federal Reserve System engagement in national and international emerging payment technology standards. He's a member of the ASCX9 American National Standards Board and Executive Committee, and performs research on emerging technologies affecting the U.S. and global payment systems. Guy has over 25 years of global experience working with new technology adoption in payments, including chip cards, EMV, mobile and contactless payments, account opening, identity verification technologies, and B2B payments.
Thank you, Brandon. First of all, following all these other speakers, I really envy you in what you're involved in right now. Ben, Peter, Eric. Eric, first of all, I have a question for you. Is ADA ever going to rebound back? It's supposed to be the better Ethereum, right? It's done the academic structured way or whatever. And the question I have for Peter quickly is that if Delta implemented that loyalty program, would I have more competition for an upgrade tomorrow morning on my flight with Delta? It sounds like that might be the case. Anyway, one of the reasons I really envy all of you is that I have worked with emerging technologies for a long time. I started working with the chip technology that's on your credit and debit cards back in 1998. And it didn't start getting implemented in the United States until 2015. Though Target did have an early one. And I did travel around the world helping countries implement that technology or put the infrastructure in for that technology. I also started working on contactless mobile payments in 2004. That didn't happen in the United States until about 2016 when Apple decided they would leverage the standards that were already in place in the credit card industry instead of trying to start from scratch and new, which many other mobile payments companies were trying to do in the past. So anyway, I don't go on any further on that. One thing I need to remember is the disclaimer. Anything I say tonight is really my perspective, my opinion. It does not represent the opinion of the Federal Reserve Bank of Minneapolis, the Federal Reserve System as a whole, or the Board of Governors for the Federal Reserve System. So in other words, anything I say, isn't of any policy concern whatsoever, and that I'll just leave it at that. So a couple things I'm going to talk about tonight, and I want to ask this group to do something for me and for the Federal Reserve, and that is to help clarify a lot of the misinformation, the rumors that are going on out there about central bank digital currency, FedNow, and things like that. So my program and what we found, I speak to a lot of Rotary groups and things like that, and a lot of times they don't really understand what are the different types of money there is out there. And what are the different payment systems that are out there? And you really need to understand that to be able to understand what FedNow and what a central bank digital currency can be. And all this sounds like, well, it's all circling around the circumference of blockchain, and so it's true. I'm not going to be talking about blockchain. I oftentimes do give talks about blockchain, and one of the more interesting things is about the decentralized aspect of it. And I'm going to talk about that first. Believe it or not, the most decentralized money ever, probably, ever is a strong word, but in the United States, was our money pre-2013. Every single bank had their own currency. Therefore, if there was ever a financial crisis, what happened was that merchants didn't know if they could trust the money or not because the money was as good as that particular bank managed their liquidity of that bank. And every dollar looked a little bit different, too. So if you're into counterfeiting, it was probably a counterfeiting heyday back then. So what happened is 2007, there was a financial crisis, and commerce seized up, largely because nobody knew what bank currencies they could trust. And as a result of that, Congress decided we needed a national standard dollar. And that was one of the primary reasons for the establishment of the Federal Reserve System. So up until that point, we truly had decentralized money in the United States. It didn't have some of the benefits that decentralized money has in a blockchain where you have that traceability, tracking, and all that type of information. So the other aspect about that is it's kind of the wild, wild west. Many people look at all these cryptocurrencies out there, whether there's hundreds or there's thousands of them probably. You don't know how well the liquidity of each of them is managed. Same situation they had back then, which of course then creates volatility, concern, lack of confidence in the industry. And that's one of the big challenges I think that any blockchain system having to do with currency is going to have to deal with, is how do you develop the confidence in that, that you're managing the liquidity of it effectively. Let's talk about money types. Right now, there is a central bank not digital currency, there is a central bank currency. It's the US dollar, right? And what makes it a central bank currency? It's the central bank holds the liability. So there's no single bank or anybody else. If you put that dollar, $10 bill, $100 bill out there, it's the Fed Reserve that stands behind that. So merchants, whoever you're going to be giving that $50 bill to, is going to trust that they're going to get the value from that, okay? If a bank fails, your $50 bill doesn't fail, right? Okay. Next type of money out there is digital money. Many people don't realize that a vast majority of the money in the system today is in fact digital. All money that you have in your banks today is digital. It's not central bank digital currency. You couldn't go to that bank and have every single one person at that bank come and say, hey, give me my money now in currency. That's what happened to Silicon Valley Bank. Too many people went there and said, I want my money all at once. There's no bank in the country that has a paper dollar for every digital dollar they have in that particular bank. That's not the way the banking system works. So anyway, there's a tremendous amount of digital money. So if you look at that, here it says 4.6 trillion in demand deposit accounts. What we used to call checking accounts, demand deposit accounts. 13.6 trillion in other type of liquid accounts out there. But they're digital. We refer to them as commercial money. It's the bank's liability. So if a bank goes under, they're the ones that have the liability for that digital, and this is where you see if there's a run on a bank, they don't always have the money right there, such as what happened with Silicon Valley Bank. Based on a variety of other things that happened, it's kind of a perfect storm of bad luck is really what happened for all practical purposes. Then you get to cryptocurrency. Now we consider this non-bank money. So ADA, Ethereum, Bitcoin, all the different ones that are out there. It's a cryptocurrency, and a cryptocurrency basically typically is backed by a blockchain. And oftentimes cryptocurrency, this audience, you could probably teach me this, so I don't know why I'm saying this, but it's the fuel that funds the settlement system for it. So the key thing is, how has it become decentralized? Well, the mining pays for someone else to invest in the equipment to do the processing of it instead of having a centralized processor. That's a really big difference and a very, very big thing. The next thing is central bank digital currency. So right now, the United States, there is zero. So I'm not going to go into this in much right now, because towards the end I'll talk a little bit more about what specifically is central bank digital currency. But the clue here is that if it's a central bank, we hold the liability. That means if you tender it, we're the ones who have to make sure that the receiver receives the value of it. So now I want to talk about our current existing payment systems. For the first really electronic payment system we had in the United States, if you don't talk about credit card systems, which also are all electronic, was the ACH system, automated clearinghouse system. And demand deposit, basically where a lot of your salary, if you get that electronic deposits of your salary, that goes through the ACH system. Almost all credit cards are settled through the ACH system. And what it means by settlement is that's the transfer of the money from bank to bank. So it doesn't have any connection to the consumers at all. Historically, it has not. So you do all these credit card transactions. They have all these systems that process and decide, gee, this belongs to that bank, this belongs to that bank, and the merchants should get paid this much. That merchant works with that merchant. And this whole big switching, processing, clearing system. And then at the end of that, they have to say, well, gee, we need to transfer the money across to all the banks for this. It's the ACH system, that backbone that does that. 2 entities in the country run the ACH system. a consortium of very large banks, the Clearinghouse in New York, and the Fed Reserve. The Fed Reserve established the ACH system to make sure the small and medium-sized banks around the country would have access to it. Otherwise, if you just had one system, they would probably only provide it to the largest entities and or where it's economical for them to do it. So the Fed Reserve stepped in and said, we need to help make sure this is affordable by any small independent bank and credit union in the country. So we're sort of the service of last resort to make sure that there's some equity in the system, equality in the system. So generally, 2 to 4 days that historically is taken for this to clear. So if you used a Venmo or something like that, and it took 2 or 3 days before they used to get access to it, that's because the settlement system behind the scenes took that long for that to be transferred between banks. About 4 years ago or so, they implemented same-day ACH, and there are a couple of windows. So now every few hours, the banks, if they can prepare the files in time, can transfer money between each other. Okay? They call that same-day ACH. Again, the Zelle system, almost all of the Venmo, if you don't choose your debit card, and even if you did, you choose your debit card, it's probably going to end up going through the ACH system in the settlement backbone. Next is the FedNow system. How many here have heard of the FedNow system? That's pretty good. I go to a lot of conferences yet where a lot of people still don't know what it is. So we're going to be releasing it here in July. We've been working on it for 4 years. And basically what it is, I saw a slide up here that I think it was Eric had instant settlement system. And that's basically what FedNow is. It's the ACH system moving. That's a file-based, batch-based system. I think most people here are probably technology-oriented. And that's moving that to a message-based system. And by definition, a message-based system, you can now do things more instantly. Though we had to implement a tremendous amount of changes within the Fed Reserve system to facilitate that instantaneous transfer of funds between the financial institutions. We weren't geared up for instant, we were geared up for end-of-day processing, right? So there's been a very significant change, whole new system, technology implemented to facilitate that FedNow. It is very much like the ACH system. It is a service provided to other banks, okay? And so with that, that means that the other banks will have to implement things such as Zelle, or Venmo could decide to use the FedNow system if it's economically practical, or it makes good business sense for them to do it. There could be a lot of B2B business payment systems that could also use this FedNow system, or there's the Clearinghouse, that other entity that runs the ACH system. They have something called RTP, real-time payment system. Okay, so they're up and running. They've been running for about 3 years. We came in because many of the small, medium banks said, hey, we need to make sure that we have access to this instant payment system. Why? They're fearful that at that time that they may lose their deposits, and that's the foundation of the lending system. If they didn't have Venmo or something like that, they thought maybe they're going to lose their depositors. What if only the largest banks in the countries had Zelle? Would the millennial generation, would the college students also, would they start moving their money into the larger banks that have that because we didn't have it? So that was a lot of the fear that's driving it. The P2P payment started by Venmo. Okay, so again, the Fed Reserve, the TCH, RTP system, it's bank-to-bank transfer. There are, for the first time for us in the Federal Reserve, that there are going to be retail systems that will more closely touch this back-end settlement system. So again, the Venmo and Zenmo. If Venmo and Zelle, that's right, that is good. So if they were to start using the system, suddenly you're starting to face things like what Zelle is facing today. They are facing certain scam fraud out there. And the credit card world has been dealing with all kinds of fraud for many years. They've become very smart and have implemented all kinds of systems to fight it. And there's probably about 8% fraud going through it, and that's hundreds of millions of dollars that the credit card industry spends a year, cost of doing business. But for most of us, hey, if we experience fraud on a card, they make us whole, right? It's created an interesting situation for these real-time payment systems because they're basically saying, hey, this is instantaneous settlement. With the credit card system, it wasn't instantaneous settlement. The settlement was taking a day or two or so behind the scenes, and a merchant and an issuer could basically dispute the charge and find out who's actually going to cover it if it was fraud. Instant settlement doesn't allow that. It's the money's been taken, it's been transferred. Give me that money back, that was fraud. The bank probably isn't going to be willing to do that. Who's going to absorb that fraud loss? So right now, that's a big thing that's happening within the instant payments industry is how do we effectively educate the consumer public that, hey, when you do an instant payment, and if you're not sure you're sending it to the right person, the ability to recover that is much, much more difficult and less likely than what you will experience in other payment systems that are out there. That's because, again, the amount of tax services out there, the extent to which us consumers are gullible and can fall for various phishing attacks and things like that. So this is basically what's happening in the public. Is a lot of people are positioning this, if you look on the internet, that the FedNow system is central bank digital currency. It is not. It's a transfer system for commercial bank money. So the money, that digital money that I opened up with that's in the commercial banks, they need a way to transfer money, settle between each other for what we and businesses do as spending. Okay? And when they do that, this is a faster system. That's all it is. It's an instant-based system. It is nothing else. It is a liability of each of the banks still. It is not a central bank technology. It does not have anything in it that allows any type of tracking. It can only do tracking of a bank might have 50,000 transactions. It comes to us historically in an ACH in one $50,000 or 50,000 tracks for $400,000. Or in this one, it'll come message-based, but we're just passing it through and don't have any insight into it. Okay? So hopefully there'll be questions on that. Please get the word out. You see all these things out there. It's a central bank digital currency. They're going to track you and everything else like that. It just doesn't have that capability or anything close to it. Now we go into central bank digital currency, and please cut me off, or if I have 5 minutes, let me know if I'm going over. Central bank digital currency. This is kind of a weird graphics. I apologize for my graphics. I didn't have a talented graphic teams to put this together for me. So if you look on the right-hand side, that's supposed to be suggesting is that in a central bank digital currency, we have two options. We can start holding consumer accounts, and the consumers, we hold their account, and then when you're doing the spending, it's just working off of our system, right? So it's a direct to the consumer. On your left-hand side, that's what we call an intermediated central bank digital currency system. This would be where, since it's central bank digital currency, we'd be issuing it. However, it would be the commercial banks managing it. Because guess what? They have all the personnel, the systems, well, I shouldn't say systems in place, but they basically have the structure in place for customer service. And central bank has never had the authority even to hold a consumer account, let alone put in everything in place to provide customer service for anything other than treasury services. We can do it for that. So which way do you do it? And this is one of the big things. A couple of the big questions is, if the Federal Reserve were to issue a central bank digital currency, first of all, we'd have to get the authority given to us, granted to us by Congress. Second, Treasury would ask us to do it, because we're sort of an operations arm of Treasury. And then we'd have to implement all the capability for doing that. And so the question is, do we try to do it like that? Or if we were to do it, do we try to make it so that, again, we issue it, but we then provide it to the banks, and the banks do all the management of it, other than the life cycle, where today at a paper dollar, when we have $80 million a day going through the Federal Reserve Bank of Minneapolis. And we go through it, and we decide which ones are in bad shape, and we throw them out. Or we don't exactly throw them, we shred them and all that kinds of fun things. And then we'll indicate we need more money printed or whatever to replace the one that was shredded. So that type of life cycle management aspect of the digital currency is something that the Federal Reserve would definitely continue to do, just in digital form instead of a paper form. But there's a lot of questions about what's the best way to do this type of thing, and there's a lot of things that Congress would have to pass and change for us to be able to do it. So there's the direct, which is direct to the consumer. There's the hybrid, and then there's the indirect synthetic. And I'm not going to get into indirect synthetic at this point, but the big thing is, do we go through the banks to have them manage it with the consumers, or do we try to manage it directly? And I think the last thing in summary, what is a central bank digital currency? It's a claim against the central bank. That's kind of central banker terms. It's a claim against us, the central bank. It could be wholesale only. What we mean by wholesale only, and there's a lot of debate about what is meant by wholesale only globally by the central banks. It's basically between the banks themselves and maybe at the corporate level, but not to pay for services at a retail establishment or at Amazon or any place like that. So when you say then we could be for a retail, for general purpose individuals, or sometimes referred to as retail, again, meaning that it could be used at a retail counter. Just like FedNow right now with an RTP right now, those settlement systems, they cannot be used at a merchant place right now. There's no solutions out there that allow that right now. They might work towards that, but there's a whole lot more infrastructure that has to be thought through to facilitate that acceptance of it, and then the whole the settlement will be instantaneous, but just facilitating that acceptance and the authorization, validation, all those types of things. And then the other thing, this is the big thing, this is the really hard thing. I think, Eric, again, you might have mentioned something to the fact that this money can be smart. Hopefully it's not going to be AI smart too quickly here, but basically that if you had something, and maybe it was you, Peter, who said it, that whether it's legacy planning or if you're selling an object and how you could earn money off of that long afterward because of the tracking mechanism that's built into blockchain technology. Well, that would be a policy type decision, right? So now we are doing a lot of research on this and have been doing research on this for years. Gee, if we were to do this, what would be the policy decisions? And the Federal Reserve wouldn't make the policy, somebody else would make the policy, and we would just basically be implementing it for the most part. We would provide perspective and educate and things like that to those decision makers. But what would be the policies you would integrate into this money? One of the clear things that within the United States is that it would be anonymous. It would be anonymous. Just almost unbelievable that wouldn't be. Remember my disclaimer at the beginning, my opinion. But it would, in China, they've done something kind of interesting, it's a hybrid. So up to a certain price point, it's anonymous. But when it gets a higher value transaction, then they start tracking it. Now, probably because there's so much noise in the smaller transactions, what value is it for them? And they're sort of a controlling state. So when you get to the larger dollar denominations, or renminbi, or CNY is what they call it for their cryptocurrency, then they want to watch and understand what's happening with that. In the United States, basically the view at this point in time of what I've heard from everybody pretty much is that it's got to be anonymous. That type of tracking is just a complete non-starter with it. So where are we right now? Again, I don't have the exact answers other than that we are doing tremendous research to understand blockchain technology and how that could help with it. We're doing a lot of research on the policy side of it, understanding it. We're doing a lot of research on how would you roll it out, how would you issue it, how would you manage it, and all that type of stuff. So if we get to the point where Congress or Treasury say we need the Federal Reserve to issue a central bank digital currency, we would be ready to do it. It would probably take us several years, 3 to 5 years to do it, given what we've learned with our FedNow system. It took us about 4 years to start from scratch to get that rolled out. So I think for a synopsis on that, at this point I can just open it up for questions if anybody has questions. How much time do we have for questions? 2 minutes. Okay, yes?
On the topic of commercial money being liability to banks, correct me if I have my history wrong, but since the FDIC was established in like 26 or something like that, has it ever allowed a bank to fail and then not make depositors whole? Like, how would that be liability to banks? If they're about like the FDIC limit, let's say.
Well, first of all, that's out of my area of expertise, but I think you're asking, has the FDIC ever allowed a bank to fail, did you say?
Ask? Not make depositors whole, so it wouldn't be, like, for instance, like SVB failure, like there are a lot of business accounts that are over the FDIC 200K limit or whatever.
Right.
And they failed, and then they still made the depositors whole and wiped out the equity holders. So how would that be a liability to the bank?
Well, okay, so basically to avoid a greater run or fear in the financial system, there was a decision to make everybody whole on that. And that was kind of a strange situation because Silicon Valley Bank, and I'm not an expert on this, so I want to make this very clear, so everything I say right now take with 2 grains of salt. But first of all, you had a lot of deposits going into that financial institution very rapidly. And they're put in a situation, I've got all these deposits, what do I do with this? And be wise with what I do with it. And so they did what they thought and what most banks around the country thought would be a very safe thing to do with the money, but then they didn't expect with the social media and the I call it mass connectivity that exists now. Somebody got fearful of something, word got out, and everybody all at once said, I want my money out. That was just the confluence of a lot of really bad luck at the time. And you can read reports on analysis on exactly what happened, and yeah, in retrospect, they should have done things differently with that deposit money. But again, I'm really not an expert in FDIC or any of that.
And I think the last thing is summary. What is a central bank digital currency? It's a claim against the central bank. That's kind of central banker terms. It's a claim against us, the central bank. It could be wholesale only.
It needs congressional authority. We do not have the authority to it.
Only globally by the central banks. It's basically between the banks themselves and maybe at the corporate level, but not to pay for services at a retail establishment.
That's a good question. We don't know either. That's one of the questions we're trying to answer and understand better. Maybe it would never die.
And when do you see the timing of that decision, just so that I can track your thinking?
We keep watching what other central banks are doing around the world. We're working very hard on improving the cross-border payment system itself, independent of central bank digital currency, and have a lot of discussions there. So we're just doing everything we can to be ready for if Congress were to say, we need to make this decision. We don't believe, many of us don't believe that we need it for functional. There isn't anything out there that we believe it truly solves for. My group actually did some research a number of years ago about, we call it the security aspects of central bank digital currency or cryptocurrency. And we identified in our small little group all the potential new attack surfaces that would be there that we don't have fraud mitigation for because they were never there before, right? And you see this in the wallets. You see this, what's been happening for some of these exchanges out there, and the how people are being spoofed into giving up whether their keys for the wallets or whatever the case might be. So we really are kind of just making sure that we understand what blockchain brings to the table. We understand the different platforms of blockchain. We're preparing on the data policy or the payment policy side of it, just trying to be ready. And there really isn't, I don't think you could find anybody in the system that could give you, well, they could probably give you better answers, but not more clear.